Loren Keim back with Real Estate's Next Level and the Goodman Center for Real Estate Studies at Lehigh University. Today, I'd like to welcome Joe Posh of Posh Properties, who's going to spend some time talking about his firm, how it evolved, and some of the challenges of developing commercial real estate in today's climate. I am particularly interested in what he has to say today because we're in the middle of the COVID pandemic. We have retailers and hotels having some significant issues and challenges. And Joe, of course, owns quite a few retail projects and hotels. And of course, we just went through a contentious election that may significantly impact the commercial real estate development industry. As a quick introduction, Joe has developed just about every form of commercial real estate there is, including retail projects for CVS and Starbucks and Lowe's and WaWa, Advanced Auto Parts, and many others. He's done a lot of office properties. He has developed hotels, both long-term stay and short-term, and his firm has projects in 6 states along the Northeast and Mid-Atlantic. I believe he's doing some warehousing projects as well. So, Mr. Posh, I will let you take it away.
For that. So as Loren mentioned, my name is Joe Posh. I am the managing partner of Posh Properties. We are a Bethlehem-based real estate development firm, actually started by my grandfather in 1945 as a construction company, and has evolved purely into development and investment anymore. It's what we do. So as Loren mentioned, we had a mostly started in the retail business, building some stores, grocery stores type things. And then we got very lucky on a relationship with CVS Pharmacies in 1988 when I first started in the business. And believe it or not, they were part of a company called Melville, which was a large conglomerate based out of New Hampshire that really nobody wanted to do business with. Melville was primarily a shoe retailer, and somehow they got into the pharmacy business with CVS, which stands for Consumer Value Stores. I'm not even sure it started as a pharmacy, but it evolved in one. And when we did our first store with them, like I said, really nobody was doing their leases. Rite Aid was a hot retailer around here. Walgreens was the biggest operator. And of course, CVS now is massive. So we got very lucky with that relationship, and we built 31 stores for them over the years, and we still own quite a few of those. Again, built a lot of power center type things, Lowe's anchored, Home Depot anchored, giant food store anchored stuff, and quite a few medical office complexes, things like that. So we consider ourselves pretty much multifaceted as far as product type goes. We've gotten into some industrial type use. We are in 6 states now, mostly Pennsylvania based, but we have projects in New Jersey, Connecticut. We have a fairly sizable presence in Columbus, Ohio, Delaware, Virginia, and a little bit in Maryland. So I'm looking for more opportunities. As Loren also mentioned, in 2008, we opened our first hospitality project, which was the Hyatt Place in downtown Bethlehem. Probably a place a lot of your parents have stayed when they visit for school. Pre this going on. It services Lehigh University quite often for the parents there. And that project has been tremendous for us. And as our first hospitality project, we have since built 3 Woodspring Suites hotels, which is a budget extended stay product. Built our first one in Wilkes-Barre. We have in Harrisburg. We're under construction in Philadelphia right now. We have a site outside of Princeton that'll start next year, and a site outside of Hartford, Connecticut that will start next year. Like I said, it's budget extended stay, which is the complete opposite of the Hyatt. It's generally a transit hotel for contractor types, people between residential uses, moving into apartments. The average stay is over 21 days in these properties. So it's kind of a hybrid hotel apartment type project. In today's environment, the hospitality industry has been pretty much destroyed by the COVID pandemic. Our Hyatt hotel, who in March, April, May, when we would normally be running 85% occupied, we were running single digits. However, the the Wood Spring Suites, interestingly enough, and that sector, the budget extended stay sector as a whole, has performed very well. I think that's a factor of, one, its budget, so people still needed to be places on occasion, and they stayed where it budgeted, especially during those times. But what we saw was that the more residential extended stay, where people were between homes, between apartments, we get a lot of business where somebody's moving into an apartment May 1, but they had to be out of their house on April 12th. So they need somewhere to stay for 3 weeks. So we were getting those guests, and they've been staying for months at a time because they don't want to move into an apartment because of unknowns that were all very prevalent this summer. So anyway, I'm digressing a little, but those properties have held up extremely well. And we are continuing to build those, although financing them has yet to be determined how the hotel financing industry is going to work out for the next couple quarters. It could be very tricky. Anyway, so I wanted to talk just kind of on high level with what we do and how we do it. Currently, we have several projects under construction, like I mentioned. The Wood Spring Suites in Philadelphia, which is in the northeast section. We have a property under construction in Mount Pocono, which is a Starbucks and an Aspen Dental. We've got a couple properties under entitlement process, which is the process from taking it to raw land to approvable land to buildable permits. We've got a couple Chipotle deals, another Starbucks deal. So those are kind of tenants that are growing right now. In retail, it's been a slow 5-10 years of tenants having the what most people would call the Amazon effect, where specialty retailers have been squeezed very hard, even to extinction, some of them. So the death of retail, which I think is overblown a little bit because people still like the social aspects of shopping. And of course, as I mentioned, the tenants we're working for right now, which are heavily Starbucks, Chipotle, Aspen Dental, all can't be done remotely or deliver or any of that stuff. So although food can, of course, but they still need to deliver from a certain spot. So those retailers are growing, and they're growing fairly aggressively. We've been given a list of, I think, a dozen locations where Starbucks wants to penetrate and build new facilities. And Chipotle is very active. Aspen Dental, from being shut down, for 3 months, this summer to being again very active. So there are some good retailers, and those are good retailers. Obviously, their credit is excellent. Their leases are very good and financeable. So those are good things. So when we look at projects and to go into projects, we tend to have two ways of doing it. We have tenant-driven projects, which I mentioned. If Chipotle or Starbucks says, "Hey, we want to be in Mount Pocono," so what we do is we do a lot of legwork ourselves, but we use a network of brokers from some of the big firms, CBRE, JLL, some of those guys, to do a lot of the legwork for us on the land, the raw land location side, to see what's available, what can be available. Usually the best sites are not marketed at the time, but are known in the network by brokers that can be bought or potentially coming in the market. Those are the sites that tend to be the best for development because they haven't been picked over repeatedly. So again, we do a lot of tenant-driven work. When we did CVS's, we used to have calls with them weekly where they would say, "Hey, we need to penetrate this market, this market, this market," and we would do just a lot of driving around. Real estate's a lot of driving around, looking at sites, standing on sites, looking at the market. So that's what we call more the tenant-driven side, which is the best kind of development, going in with a tenant in hand, knowing what your base economics can be and will be on the way out. The other type of projects is we look at less frequently, but certainly we do, would be a piece of land that might come available that is extremely well positioned, and we go, this site is very developable. It's got utilities, it's got traffic, it's got all the things that we'll talk about a little bit later that get us into a site, and that we know we can achieve, an end game of having open tenants. For instance, we just recently bought in January of this year a site in Forks Township, which is north of Easton, above Lafayette College there, a 6-acre site that's been on the market for a real long time. It was an old office building, and the seller finally decided he wanted to unload it. He was messing around with it for many years, and he didn't have a lot of experience in the retail development side. So he discounted it huge. So we did a quick close, a site that was, again, for sale for $1.5 million. We ended up paying $600,000 for, as long as we closed in a matter of weeks, which we did. The real rub on this one, and this is a little different for us, but it's 6-acre site. The traffic is hard. It's between 2 traffic lights, but so you cannot get another traffic light where this property is. It's too close to the other 2 lights. PennDOT or any of the DOTs generally require a certain amount of distance between traffic lights for stacking, turning, all the things, as you're driving around, you realize. So we could not get a traffic light here. And without a traffic light, without full movements, what we call full movements onto a site would be left ins, left outs, right ins, right outs. So all 4 movements you can do, going through that stuff. This site, we're going to build for us anyway, our first traffic circle. PennDOT, for any of you from Pennsylvania, knows we don't have a lot of circles, or roundabouts they call them in the traffic world, in Pennsylvania. They're in New Jersey a lot, and some other states, and they've started to add them on Route 222 on the way to Reading, if you drive out that way, and a few other sites. So we're going to be adding a traffic circle there, which gives us 4 movements. So what we were able to do is take 6 acres that we bought very cheaply by adding this circle. And again, it's going to take a year of engineering and approvals. PennDOT is extremely slow. But by having that full movement, all of a sudden, from a circle, Chipotle jumped on the site, AutoZone jumped on the site. We're going to be able to build about 80 apartments in the back. We have a daycare operator and a car wash operator. So all of a sudden, as soon as the news came out in Forks Township, again, it's a high barrier to entry market in that there's not a lot of land. The land that is there is a tricky development because of the highway systems or the zoning. This site is zoned well, but it had all the shortcomings on traffic. As soon as we were able to breach that traffic issue, we were able to add a whole bunch of demand that wasn't there before. So that's how we look at a site that was raw. We didn't have tenants going in, but we're able to look at a site again that we could add value to. And that value is again, for just experience, luck. I keep talking about luck because I think it's always good to be lucky, and add those tenants, and they jumped right on. So we're in the process of that. We've got our first meeting actually in the planning commission tonight. So hopefully that'll go fairly well. But again, fairly well in my world still takes 12 months of time. So I'm going to talk a little bit more about the process that we go through. So again, site identification, we talked about tenant driven or just quality of land driven. So this is kind of the two ways we go about looking at sites. Once we identify one, and again, I'm just talking kind of on high level here, we then have to get legal control of that site, which of course means a contract, a right to purchase, or purchase agreement. That tends to go fairly quickly. Once we have that, we move to some engineering work. We hire all outside civil engineering. So we have a small office here, even though we do a sizable amount of development. We do it mainly with outside engineers, outside legal, outside architects, all those things, even property management, which we'll talk about a little later. So we've been using Bowler Engineering in most of the Northeast here for I'd say 80% of our projects. They're a sizable firm. I think they're up to, I don't know, a dozen offices up and down the East Coast. So they do a lot of retail for the retailers who are doing development on their own or who are doing engineering services on their own. So if I have any site and I say I'm going to do an advanced auto parts, they have the ability to pull up all the advanced auto parts prototype stuff, from their files, and it's convenient, and it makes it go very smooth for us. So we then have to get engineering drawings at a level we call just sketch plan, or preliminary plan, which we have to get to tenants, and then we negotiate the lease. So if it's tenant we've done leases with before, for instance, like Chipotle, we're doing our fourth Chipotle now. So we're very good with their documents. So in other words, I send to my attorney, I said, we're doing a Chipotle deal, all the nuances and subtle things in their lease, and their lease is, if I say it's 100 pages long, I'm probably being generous. It's probably much longer than that. We've already vetted all the stuff. We know what they will capitulate on, and there's certain things they'll give in on. But when you have their kind of mass and power in the market, there's many things you can't get fixed. So you may disagree with some of the lease terms, but it's a take it or leave it with a lot of these guys. Some are better than others. Starbucks, Chipotle are pretty good. Aspen's very good. But then there's other companies that very take it or leave it. We then, once we have the lease signed, we keep the engineering moving to the next levels, which involves all the approvals. Now, this municipal approvals, entitlement, or whatever you call it in a particular state, is probably the most frustrating and time-consuming part of our work anymore. Again, getting from site selection to lease often takes several months. But the amount of municipal work that goes into approvals today is onerous. We tell tenants in Pennsylvania, if it doesn't have a major traffic impact that PennDOT's involved, we are looking at 9 to 12 months from a start of engineering to approvals. If it has a major traffic issue, like Forks Township does, you have to add 6 to 8 months. So you're looking at 18 months of time and money, particularly money, because to satisfy all these entities for approvals, it's a lot of paperwork. It's a ton of work. So, for instance, in Forks Township, I'll keep using an example. You have the township, of course, which you go through their planners, then their supervisors, zoning if you have any zoning issues. You have to go through all their boards. You have to get reviewed by the fire department, the forester, believe it or not, that checks your trees and your other stuff. All the utility companies. Many of the municipalities have their own water or sewer. Well, a lot of sewer suppliers. Water's being consolidated quite a bit, and that's a very interesting thing. From what used to be 30 years ago, a whole bunch of scattered water departments have been bought up by a lot of bigger companies like American Water now owns a lot of systems throughout the Northeast, and they're a huge company. So that's good and bad. You get a lot more homogeneous design and other elements, but you also get some more rigid and expensive hookup fees and engineering that goes into meter pits and meter design. But that's something that has changed, I'd say, for the good. The water suppliers, you get a better quality water as well. There's often condo associations or other input, from neighbors, and that's just to get to an approval standpoint. Once you have approval, you then go back to the municipality for building permits, and that that process has also altered considerably over the years. It used to be these municipalities would have a building permit officer or something like that, but what they've done in the last quite a few years is sub that work out to larger companies that review plans, do building inspections, do certificate of occupancy issuance. And again, I think that's probably a good thing too, because it's made the process a little more professional. In our business, what you never knew going into, especially if you were building in some of these more rural areas outside of the bigger cities, what you were going to get on a staff level with permit officers or review processes. Because when you're dealing with a board say a planning board of volunteers, you can get anything on those boards. You can get, you know, some board people that were sitting at home and wanted to make a difference and don't have much knowledge or experience in any of this, that might have opinions on, you know, not building, you know, in old cornfields or saving old structures, or again, it could be anything. And it was often not very professional. It's gotten better, I think, because there's been more education going on with the codes, because it's always been the Pennsylvania Municipal Code, in Pennsylvania specifically, requirements on how these boards can act. The problem was a lot of them didn't act that way. And your recourse was, well, a legal process, which could take years, if at all, success, or you had to capitulate to, you know, some of these things they were asking for that were not legal, not legal, that they didn't have the right to ask for, but they basically held it over your head. So we used to have to do a lot of that kind of stuff, and it made it a lot more tricky. So today's a little more professional, but also takes longer, because the stormwater rules, the rules for water and sewer, stormwater particularly, the quality watershed type documents, which we're all for, you know, protecting the water quality and waterways, but it tends to be onerous work, and I keep using the word onerous. There's a reason for that. So those things all filter into the things that delay us. And again, all the meantime, we're spending legal money, engineering money, architect money, deposits on land. So when I first started, if we were building a facility for CVS and the rent was $15 a foot, that seemed about normal. That deal today, same deal, is probably $45 or $50 a foot. And a little of that is from construction costs, of course. They keep going up. I can tell you lumber costs. We just we're building a hotel in Philadelphia, and from our initial bid in February on the lumber package, it's gone up 25%, from $308,000 to like $416,000 or $17,000, and that's just the lumber price of the material. I don't know what's driving that. You know, it's a commodity, so you can follow those prices, and that index is just soaring. And there's nothing you do about that. You know, sometimes you get, when the petroleum filters through some of these costs, you get plastics and drywall and metals that can soar. Gasoline, of course, they seem to soar, but they never soar back down. It's always, I'm not an economist, as you can tell. Anyway, so that's how we get into those deals. And then we go through the construction process. We used to build a lot of things ourselves. Again, I grew up in the construction business, but we don't do those anymore. We now sub out all our construction to third-party contractors. We put it out to bid. There's a few contractors we have preferred relationships with. And again, when I said we run a small office here, we manage these projects with, again, a handful of people, where we could never do that if we did all these things with ourselves, which you leave a little bit on the table, you know, from a profit standpoint. But when things are slow or not active, we can sit on our hands and not worry about making payroll or any other kind of stuff. So that's a choice we've made years ago. I made years ago, and I'm pretty happy I did. We used to have quite a few people on staff in the construction side, and I don't miss it at all. Anyway, so then once you have a property open, say, let's talk again about the Mount Pocono deal, which is under construction. So it is a Starbucks and an Aspen Dental. The steel's up. We're framing the building. The plumbing is going in. It's coming along. We're supposed to deliver space to both those tenants, I believe, in January, which I think we're on track to do, although it's been a little slow with the permitting process up there. So once we turn that over, they have their fit out work to do. Both tenants should be open by, I think, April 1. Should be April 1. So we start collecting rent depending on our agreement. Sometimes there's some free rent periods in our leases on these tenants. But let's say April 1, they start paying rent. We also ship out because it's a whole lot of work, and it's not good profitable work for us, the property management side of our business. So when we have a deal open, it varies from complexity. A CVS or a freestanding retailer like that, Advanced Auto, AutoZone, Dollar General, once they're open and it's a triple net lease, I think you guys have probably talked about the difference between triple net and gross leases or modified gross leases. But quick recap, triple net is where the tenant pays for and maintains the property generally on their own. So CVS cuts their own grass when it's a freestanding CVS anyway, cuts their own grass, mows or plows their own snow, utilities, everything. So we do so little there once those properties are up and running, basically collecting a rent check, paying a mortgage, and occasionally, getting reimbursement or billing for the real estate taxes. It would be unusual for a municipality to build a tenant directly. They tend to only build the owner for real estate tax. It does happen occasionally. Some tenants or some municipalities will build directly, but that's unusual. So that's the easiest of properties we have to manage. Then you get into multi-tenant office buildings or flex buildings for industrial that have common spaces, common bathroom facilities, utilities that are split or billable above a threshold. So that work that takes a whole lot of work, from even changing light bulbs to janitorial. So we have a third party company that does all that work for us. So anytime we add a property like that, once the tenants are up and in there, we then shift the responsibilities of the management of that property to a third party. I think, which is fairly common for development companies our size, where we don't want to house that in-house. Again, it can be another operation that you can make some money for. Obviously, the management companies, get a fee, but it's very specialized. And if you don't have it set up, to do it that way, then in my opinion, goes back to my reticence to add employees beyond what we need. I think it's best. What we do keep in-house, and what we would call more of the asset management side. So any of these properties, we again oversee the property manager. We arrange the financing from the debt side, the equity side, all that other stuff. So again, what we consider asset management, we talk about, do we want to sell a property? Do we want to refinance the property? When it comes to re-tenanting, we make those decisions on what new rental rates or structures should be. So we call that more asset management. So we do that in-house because I think it's the control you want with your investment and with your partners, if you have any. We don't do a whole lot of partnership work, but occasionally we use an outside equity for some of the deals, particularly in the hospitality deal. So as I shift to hospitality, when we talk about, again, the hotels we operate our own, we do not operate any hotels. Hotel management companies, completely separate from the property management companies we just talked about. They, of course, are very specific in their own right, and we use two. We use one company that does the Hyatt because they have experience in, that level of hotel, which is called select service, which means, it doesn't have full service banquet type things or restaurant type things, but provides almost all the other services you would expect in a modern quality hotel. And then in the Woodspring side, we use another company. They're called Nationwide. They do, I think, about 60 or 70% of all the Woodspring suites that are built and operating. So what they do for us, we hire them under a management contract. They charge us a fee, currently 4% of operations, plus the franchise. Those are choice hotel products, which is the largest hotel operator in the world. I think there are over 8,000 hotels these days. They, of course, get their fee, which is 5%. And then there's also generally up to a 1% marketing fee or other outside advertising, reservation system fee, any of that stuff. So really on the hotel side, you're paying about 10% of operations for outside management, franchise fees, other costs. That varies across the chains, but it's not by a whole lot. So those companies, again, we hire to do those things. They hire the employees, they do the accounting. We get daily reports, all cloud-based anymore. Where anywhere I am, I can pull up on my computer into a portal. I can see any operations for any property at any day, year-to-date stuff, the whole bit. It's pretty great. So that's how we do those property management and asset management. Moving forward in hospitality, again, I wouldn't build a new select service, full service hotel today. It's just again that market, and we read all the the data that comes out. The beauty of the hotel business is it is oozing with data. Like I said, any day I want to look at my properties, I can pull up on the portal my operations. But what also happens, hotels report to third-party data collection agencies. STAR is the biggest one, STR, which you guys have probably seen reports in some of the classes that you do. But basically any market, particularly in the United States, I know they do it internationally too, but in our market, I can go and say I want to build a hotel in Allentown. I can pull up a competitive set of Allentown hotels through the STAR reports that show me their occupancy, show me their daily rates for running years, monthly, daily, particular days of the week. What are their Wednesdays run? What are their Saturdays run? The segmentation of those nights, is it 30% business travel? Is it 20% leisure? Is it, whatever. The amount of data in the hospitality business is just makes your head spin. But it's helpful. And I think a lot of the other industries are trying to catch up with some of that data. And it's pretty fascinating, some of the tools that the tenants use, their technology. Starbucks, all these guys can show market penetration, impact of new facilities on old facilities. And we get that a lot. Here in Bethlehem, again, Starbucks, there's a Starbucks on Freemansburg Avenue by the ShopRite. And it's so busy that people don't go to it. In other words, what I'm saying is the cars stack up. So if you want a coffee, you go drive by and you go, damn it, it's going to take me 25 minutes. So they have what they call relief stores. So they're looking for a relief store for that store. So they have postal routes or other geometric drawings you can see that show where those customers come from, and how they, how frequently and where a relief store would be best. And, it doesn't always work that way, of course, because the sites aren't available, especially in a market like the Lehigh Valley, which is well built out already. But there's still opportunities. So again, that data is catching up, and it's pretty fascinating. Data's so again, I want to talk a little bit about technology too, because that is it's really starting to impact our business. You heard, of course, when the COVID started, all the work for home stuff. So we have a fairly sizable portfolio of office properties. A lot, mostly medical, but some not medical, which had a lot of impact from the COVID. So a lot of the work from home type stuff. They've been talking about that. The people in the know that office properties have been impacted for years with this work from home and the technology and the ability to like a hybrid work for home that started to happen, well before this year. What we've always read was that the efficiency of those work from home employees was not as good as the work in the office properties. What surprised me a lot when COVID first happened and everybody went remote, most everybody, that the data came out like, well, we haven't lost anything. You know, everything's still efficient, everything's still this. And I was always suspect of that because that hasn't been the data for a decade. And what we're seeing now is it's starting to filter out that it's not as efficient. People are not getting as many things done. They're not as productive. Productivity is the big word, especially on the creative side, because what they're seeing is these creative groups on Zoom aren't as effective as somebody sitting around a table or around an office and doing the creative things. A good friend of mine, he's the creative director for Rose Art. They make crayons. Well, they compete with Crayola and make other kind of toys. Their business has been awesome, but again, his whole job, he's a toy maker. He's a toy designer. It's the greatest job in the world. But he says, you know, one of the main problems they have is they used to sit around with clay or whatever they use and just kind of come up with stuff. And they haven't been able to do that. So we're starting to see reports come back that, you know, the work from home is not quite as productive in some industries anyway. I think that's going to be more prevalent. I also had a discussion with a friend of mine who works for Steelcase, which is a huge seller of desks and office office fixtures. And for years, again, this is another impact on the technology side, that the offices have been getting smaller because they have this work from home part, and you know, you got rid of cubicles and you went to this open workspace, and you see some of the stuff like, you know, Apple and Google that have ping pong tables and foosball tables. So that was swinging one way, but what he's seen in the last year, and particularly with the COVID thing, is that now new office space, they're saying there's less people load because there are more work from home opportunities. But what they want, because of, again, the virus and some other things, that they're planning on more perimeter offices, more cubicles, more privacy type things. So that may swing back where an office that might have had 100,000 square feet and would hold, you know, 300 employees, it might still be 100,000 square feet, but it'll hold, you know, 200 employees. So the question becomes, will these large blocks of office space that you hear about in Manhattan and other places, you know, the threat when this happened, well, everybody's working from home, who's going to fill these skyscrapers? That's still to be seen how that shakes out. Yeah, so that's technology. Technology's in the real estate business. You don't think a whole lot about it on the development side. You didn't used to, but I read a book. This was pretty fascinating. I just read it last week when I was away. It talked about technology and how the next 10 years could impact development. And the point of the article, well, it was an article, it was basically a white paper. But the point was that with technology that's coming out, where self-driving cars, where work from home, energy, solar, I guess is the winner in most things that are coming out today. But the big thing was technology and transportation. These guys, and they've been right about a lot of things, that the automobile, which is becoming electric, that's the first thing, becoming very electric, and that the internal combustion engine may be a complete dinosaur within 10 years. I think that's a little aggressive. And I like to drive, so I don't ever give up my car. But so electric vehicles, but also autonomously driven electric cars. So the impact of that is not that, well, hey, you don't get to drive a car. It's these ride share companies move to fully autonomously driven electric vehicles. So do you need a parking lot with a building where you would have 100 employees and you need 100 cars to park? Their point was that if autonomously driven cars and rideshare can operate 23 hours a day with just 1 hour down for service charging, what have you, you need a parking lot at all. You have an office building because people are just going to hail a ride from work, other support, lunch, get dropped off, and then some other car will pick up. That you can change the land development, land planning matrix in tremendous ways. Because right now it's very particular. You go into a municipality and you're building a store with 40,000 square feet. They say you need 2 cars per, well, basically 2.5 cars per 1,000 square feet for most retail, for some retail. And that takes up a lot of land. These guys' point was, will the municipalities adjust to that, or how fast will they adjust? Because they tend to be the slowest reactors to most things. My point is the impact on land planning and land development can be huge. If you don't need a massive parking structure with a facility, that money can be used elsewhere on efficient development, more economic utilities type design, more the alternate energy uses such as solar, which is a little expensive. And the other thing in this report, which was neat, was the centralizing of not just utilities and transportation and energy, was food use. I'm getting a little off pace here, but these guys believe that farming and farmland can be recaptured because technology exists now where you don't need a chicken to make chicken. You need chicken DNA, which can then be put in a replicator like the Jetsons, believe it or not. And this technology exists apparently. That'll become a lot more popular in the next 10 years. So that those transportations, the use of farmland, the use of transportation, and the energy that was there is fascinating. It's scary, but fascinating. The last part I want to touch on is that impacts the real estate world that we work in is political. Obviously, we just had an election. Biden's appears to be winning, have won, and that transition I expect will happen normally. But what he has talked about a few things that could have huge impact on our industry. Number one, the change in capital gains tax. It's currently at 20%. Most of our business and tax impact is capital gains, that you hold for over 12 months, what have you, sell a property, pay 20% capital gains. He's talked about removing capital gains or pegging it to standard income, which could go up, but currently to 39%. So it almost doubles. The tax load could almost double. And that's if they don't raise the tax rates, which is also a potential problem. There's others. He's also talked about removing the 1031 like-kind exchange from the tax codes. You guys probably talked about that too, but a like-kind exchange is sell a property as long as you buy in a time period that's reasonable, a new property that's worth the same or more, you can defer those taxes. That is a huge driver. I mean, huge for the resale market. If we build a Chipotle, for instance, and we sell it, we can take that gain, put it into something, up leverage into something. It keeps that transaction market extremely liquid. If that were to go away, I think you would see asset values drop by 20% right off the bat, because in fact the value drops by that amount of taxes that gets paid right away. That would be a huge impact. He's also talked about removing the step up in basis for tax purposes, which again, from an estate, someone passes, the property goes to their heir, the tax basis value for that property is at the time of death. So if they sell it, to pay taxes or just to monetize it, they only pay tax on the amount, from the current basis. If that basis gets reverted back to the grantee's basis, which often is near zero, if someone's owned a house for 30 years, say, you then pay tax on that number, which would be, again, a regular income, 40, 50%. If you add in, local and state taxes, it can be a huge drain on things like that. So the political climate is still way up in the air. My opinion, if the Republicans hold the Senate, then those things are blunted dramatically, which is probably best for everybody. Mixed control of the government, the three branches of government is probably best for everybody in a given time, in my opinion. But again, that's purely my political bent. So pretty turbulent times is my answer for most things right now politically, and with the COVID, I mean, who knows? The talk of more shutdowns could really impact hospitality. The entertainment industry is, I don't know when that comes back at all. It is reeling. I mean, crazy. Movie theaters. I mean, I always like going to movies. Can't go to movies. So anyway, so that's just kind of a high level view of what we do and how I think about it. So if there's anybody has questions, I'm happy to take any.
I'm sure they'll have a couple of them. I wanted to mention a couple of things. It's interesting. Spent the last week and a half in a different course where we have to have the students who are graduating really understand the capital gains tax, how to calculate that, how to capture, depreciation recapture, understand 1031 exchanges, understand the basis, and everything that I have them graduating with, this semester may be completely different in just a few months, unfortunately. I did want to ask you one thing. You had talked in previous sessions about some of the challenges when you're doing development work where maybe some residents will harass you at the car on the way out because so many people are so anti-development. I was curious if you had anything to say about that.
Well, yeah, that has happened quite a few times over my career from people getting up in meetings telling me I'm destroying their neighborhood, I'm endangering their kids, and I'm like, I'm building a Panera. I mean, I've had people threaten me. This project in the city of Philadelphia is a whole different ball game. As everybody who's been to Philadelphia knows, it tends to be a little more vocal down there and opinionated.
Yeah.
Sometimes in a good way, sometimes not. But we had all kinds of people fighting us, and then you add the union potential issues in Philadelphia. It can be a hostile place to do business, but we're going through and we're building. But I'd say we were delayed a year with that noise.
One of the few developments that I did myself without doing it on behalf of a developer, this is probably 20 years ago, we were building 26 houses on 57 acres. And the lots were 2 to 3 acre lots. So very, very large estates. And we had people come out into the public hearing and stand to the microphone and cry that their children were going to be killed by the traffic that was going to be created by these 26 houses on this enormous piece of land. And I do appreciate, I did not know you were building a traffic circle in Northampton County. That's amazing. The added value component that you talked about was wonderful. That's great to hear. By the way, just a plug, next Wednesday, I have the head of research for CBRE, the head of research for Cushman & Wakefield, one of the partners from PwC, and a few other really high-profile individuals that are going to be doing a workshop with us, talking specifically about what's happening with all these changes and whether or not we are stifling creativity with everybody working outside the office, and whether we will start swinging back to some of those perimeter offices and bringing people back in. We'll see what happens.
Go
ahead, I'm sorry.
Their input.
I do want to open it to everybody else. Does anyone have any questions or comments? Not often you get to talk directly to a very successful developer who's done just about every type of project you can imagine. It's quiet out there today.
See, in a class setting, we'd shame somebody into a question.
That's true.
I was going to ask, do you work with a lot of other developers and projects, or is it mostly through just your company?
Yeah, we don't work with a lot of other developers because we all want the same thing. we all think we have, the way to add value to our particular projects. Sometimes on larger or capital intensive projects, you might joint venture something. If I was tackling a project that maybe became too big for me financially, I may want to bring somebody in, but it would be fairly rare to work with another developer. We mostly keep a friendly basis because we see each other all the time in municipal settings or, same contacts in banking or engineering, but it's rare that we work with another developer.
Thank you.
Actually, does development get as contentious as the real estate business, where real estate brokers and agents really compete for that deal, or is it a little bit better in the development world?
I'd say it's a little better than the broker community, which fights for each fee. But certainly when a quality piece of ground becomes available, you can get into a bidding situation, and where you've got to kind of lay it on the table and say we can do this better than somebody else may be able to, or vice versa. But that's once that's settled, then it kind of moves on from there. But that's usually the only time.
Guys, any questions you can think of?
I wondered what your thoughts were on, I'm sure you've heard of the WeWork company. It's like rentable office spaces. Like, what are your thoughts on that? And if you see yourself expanding into that because of COVID? I know it's become a little bit more popular.
Yeah. So WeWork, which was on a huge trajectory, adding spaces. I visited a couple of theirs in Philadelphia, and they were beautiful. The problem was their economic data was not accurate. So you saw they pulled back their IPO. The head guy, I think, was pushed out. So yeah, the office share is not a bad idea. Their platform just got overdone and overvalued tremendously. So I do see use in some of our facilities in office space, where if someone moves out, where we can do a shared office use. So I do think that will continue to grow. I just think a company like WeWork has to be, rethought as far as on the value of that as a third party company in someone else's real estate. You're adding a lot of layers, I think, but I think it'll continue to grow.
I was asked the other day by the Morning Call about a development that's going on in Lehigh Valley. They're building a live workspace where actually the small businesses would live in the building and also work in the building, which is kind of an odd concept. Any thoughts on that?
I don't know. I mean, I think the mixed use projects that we see, coming up, like the Silk Mill in Easton, and some of these other projects that combine, office space and residential use and commercial space. I think that's a great way to, reuse some of these properties and to build. The municipalities have to want to embrace it, and some of these, townships don't quite understand or don't have the structure from their ordinance standpoint to do it. But yeah, I don't know. But yes, I think it's a good way to go. And if you go in some of these bigger municipality areas, I was in Greenville, South Carolina last week, and their downtown is tremendous. They've added just these great apartment complexes and restaurants and office properties and entertainment properties, and it's what you're seeing in these mid-sized successful cities. The live, work, play combination.
Interesting. John, you had a question?
Yeah. Have you found one sector to be harder than the next? Because you said you're in hospitality, retail. Have you found more backlash from the public, or harder or longer?
The approvals?
Yeah, approvals in
Yeah.
retail than in, yeah. So what's been the hardest one to get into, or the easiest sector to get into?
So from our standpoint, the big box industrial tends to get people all up in arms about truck traffic. Because obviously the distribution centers generate a lot of tractor trailer traffic. It's their whole point, obviously. So that tends to be one particular thing. When you get in retail, I think, especially quality retail, when you add a Chipotle or a Panera or Starbucks to a site, it's generally welcome because those retailers tend to be sought after by the residents. If you add a Walmart or some other things that Dollar General, even though these are very popular and successful, there's always a sector of the neighborhood that just doesn't want it for certain reasons. It tends to be irrational and emotional. People like the office building. People love those live, work, play communities where they can be built because they look, with a lot of the fountains and the walkways and all that other stuff, which is great. But it just doesn't apply for small projects like we do, like I can't build a fountain with a Starbucks or what have you. It's just walking past. It doesn't make any sense. But those two I think are the biggest. Hospitality, they tend to be built on interchanges or behind a shopping center or along the highway. So we don't get a whole lot more pushback or a lot of pushback on those things. And office development's different too. It's usually within an office park or that kind of setting. So you don't get a lot of neighborhood input there.
Thank you.
Other questions, anybody? Give you about 10 seconds to come up with something real quick. Okay, well, I do want to thank you, Mr. Posh, for doing a wonderful job explaining your side of the development business. This is what this entire program is about, real estate development, understanding it and the processes and the challenges. So it's great to hear somebody who's actually done just about everything you can in development work. So we do appreciate you being here today.
No, happy to help anytime.
Thanks. Anybody else at all? All right, then I will let you all go. Thanks again and appreciate it.
All right, thank you.
Thank you.
Thank you.
Enjoy.
Thank you.
Thank
Good
you.
luck, everybody.